Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey Prime investors, Martin Maxwell here, and welcome back to our deep dive into real estate tokenization. Last week, we opened the door to this fascinating concept, the idea of owning property piece by digital piece, recorded on a blockchain. We covered the basics, the what, the why, and the fundamental how. The potential? It's undeniably huge. Accessibility for everyone, fractional ownership, maybe even better liquidity down the road. But let's get real. Potential doesn't pay the bills, and it certainly doesn't protect your hard-earned capital. Hope is not a strategy. So today, in part 2, we get practical, tactical, and frankly, critical. How might a savvy real estate investor actually use tokenization strategically in their portfolio as things stand in late 2025? More importantly, what are the major risks, the hidden traps, the landmines you absolutely must understand before even considering putting a dollar into this space? And finally, what's the reality check? Is tokenization truly ready for prime time, or is it still a high-risk frontier? Let's build the playbook and navigate the minefield. All right, let's put on our investor hats. Beyond the tech buzz, how could tokenization potentially fit into a traditional REI's toolkit? Where might it add actual value? First, and perhaps most obviously, is diversification. Maybe your current portfolio is heavily concentrated, perhaps mostly residential properties in your local market. Tokenization, with its low entry points, offers a relatively low-cost way to potentially add exposure to completely different asset classes or geographies. Think about getting a piece of a commercial office building in another state, an industrial warehouse, or even international real estate without needing massive capital outlays or navigating complex foreign ownership structures yourself. It allows for diversification in smaller bites. Second is accessing inaccessible assets. Ever dreamed of owning a slice of that iconic Class A office tower downtown? Or a piece of a luxury hotel, assets typically reserved for institutional players or the ultra-wealthy? Tokenization might offer a pathway to fractional ownership in these trophy assets that would otherwise be completely out of reach for individual investors. Now, how does this compare to something more familiar, like a real estate syndication? We touched on the syndication model back in episode 69, where you pool capital with other investors under an experienced sponsor. Tokenization shares some similarities. Pooling capital, passive investment, relying on a sponsor, in this case, the platform or issuer. However, tokenization typically offers much lower minimum investment thresholds, $50 to $100 versus $50,000 plus. And theoretically, it promises easier exit through secondary trading, though, as we'll discuss, that's a very big if right now. Traditional syndications, on the other hand, often provide more direct communication with the sponsor, more established legal frameworks, and require thorough vetting of the operator, just like we discussed in episode 70 regarding the sponsor and the contract. Tokenization adds another layer of tech and platform risk to that vetting process. Finally, for experienced developers or sponsors themselves, tokenization could emerge as another capital raising tool. It potentially offers a way to tap into a broader, more global, digitally native investor base compared to traditional methods. However, let's be clear, executing a legally compliant and technologically sound token offering is complex and expensive, requiring significant legal and technical expertise. It's not a simple alternative just yet. Strategically, within our Prime framework, these potential uses fit squarely into the research phase, exploring new markets and asset types, and the expand phase, implementing diversification strategies. Okay, we've looked at the potential upside. Now, we absolutely must shift focus to the risks. And I want to be crystal clear, this is the most critical segment of our discussion today. Ignoring these risks is financial malpractice. The tokenization space, as of late 2025, is fraught with significant challenges. Risk number 1, regulatory uncertainty. This is the elephant in the room, the biggest hurdle by a mile. How are these tokens legally classified? Are they securities? Are they direct property rights? Are they something entirely new? The rules are unclear, inconsistent globally, and still very much in flux. Regulatory bodies, like the SEC here in the US, are watching closely, and enforcement actions are happening. A sudden ruling could deem certain tokens illegal securities, freeze trading, impact their value, or even shut down entire platforms. This isn't a theoretical risk. It's the single biggest barrier preventing mainstream adoption and institutional investment. Risk number 2, platform risk. Many of the companies offering tokenization services are relatively new, often tech startups. They face all the standard risks of a young business: risk of failure, mismanagement, running out of funding. What happens to your investment if the platform goes bankrupt? What if they get hacked and tokens are stolen? Remember the Mt. Gox collapse in the early crypto days? Platform failure is a real possibility, and investor funds or assets could be lost. Risk number 3, smart contract risk. The tokens and their associated rules, like profit distribution, are governed by smart contracts, code on the blockchain. But code isn't infallible. Bugs, errors, or vulnerabilities in the smart contract code could lead to unexpected behavior, incorrect payouts, locked funds, or even opportunities for theft by malicious actors. Risk number 4, valuation challenges. How much is a token really worth? Especially for tokens that rarely trade on secondary markets, establishing a fair market value is incredibly difficult. Unlike publicly traded REITs or even physical property with comparable sales data, token valuation often relies heavily on the platform's own assessments or very thin trading data. Risk number 5, liquidity reality check. This is perhaps the biggest irony. Tokenization promises enhanced liquidity, but the reality in late 2025 is often the exact opposite. Forget the dream of trading tokens 24/7 like stocks for now. Most real estate tokens, if they trade at all, do so on very small, fragmented, and highly illiquid secondary markets. Finding a buyer quickly at a fair price when you want to sell is often difficult, if not impossible. Liquidity is still largely aspirational, not functional, for many assets in this space. Risk number 6, cybersecurity and custody. These are digital assets. You need to understand how to store them securely. Are you relying on the platform for custody, holding your tokens for you, or are you holding them yourself in a digital wallet? If you hold them yourself, losing your private keys means losing your investment permanently. If the platform holds them, you're exposed to their security risks. What does all this mean? Due diligence is paramount and more complex. You're not just vetting the underlying real estate deal itself, which you absolutely still must do, just like any syndication. You also have to vet the tokenization platform, understand the specific legal structure of the offering in detail, scrutinize the smart contracts if possible, assess the security measures, and grasp the technology involved. It requires a deeper, multi-layered due diligence process than traditional real estate investing. So, where does the market stand right now as we head towards the end of 2025? Let's take a realistic snapshot. Current state, real estate tokenization is still very much in its early niche stages. We're seeing interesting projects and platforms emerge, but it's far from a mainstream investment strategy. Adoption is growing, but slowly compared to traditional real estate or even established alternatives like REITs. Adoption level. Who's actually investing? Mostly, it's early adopters, individuals already comfortable with crypto and blockchain technology, and investors specifically seeking that low-cost fractional access. Institutional capital, the big pension funds, endowments, etc., remains largely on the sidelines. Why? Primarily due to that regulatory uncertainty and the lack of mature, reliable market infrastructure like liquid secondary markets. Key challenges. What needs to happen for this to go mainstream? Number 1 is clear, consistent regulation. Until regulators provide a stable framework, widespread adoption is unlikely. Number 2 is building robust and liquid secondary markets. The promise of liquidity needs to become a reality. And number 3 involves improving standardization, user experience, and security across platforms to build trust and make it easier for average investors to participate safely. Future outlook. What's the potential long term? If, and it's still a significant if, these major hurdles, especially regulation, are overcome, tokenization could genuinely transform real estate. The potential for increased efficiency, transparency, and accessibility is massive. It could unlock trillions in value. However, widespread mainstream adoption is likely still several years away. Think 3 to 5 years at a minimum, maybe longer. And it's important to remember, it's not a guaranteed revolution. It could remain a niche area or face unforeseen obstacles. All right, let's bring this 2-part series to a close. Real estate tokenization offers a fascinating glimpse into a potential future for property investing, promising to break down old barriers and make the asset class more accessible and perhaps eventually more liquid. But today, right now, in late 2025, it remains an early-stage high-risk frontier. The potential is enticing, but the practical realities, particularly the dense fog of regulatory uncertainty and the stark lack of functional liquidity for many tokens, act as major brakes. My point of view? Approach this space like you would venture capital or any highly speculative investment. Understand the high risk involved, recognize the potential for significant loss, and only consider investing capital that you can genuinely afford to lose. This is not the place for your emergency fund or your retirement nest egg. Connecting this back to our prime framework, tokenization falls under advanced research and expand strategies. Do not even think about exploring this until your core prepare, invest, and manage foundations are absolutely rock solid. You need a stable, traditional portfolio first before venturing into these riskier experimental waters, similar to how we need a solid foundation before considering complex strategies discussed in episodes like Episode 3, Why Real Estate, where we establish the core benefits first. So, your challenge today isn't to go out and buy tokens. It's strategic thinking. Look at your current investment portfolio. Is there a diversification gap you'd eventually like to fill? Maybe exposure to international commercial property or a specific niche asset class. Now, purely theoretically, could tokenization potentially offer a solution to fill that gap if the risks were significantly lower and the liquidity was actually functional? What type of tokenized asset might fit that future vision? Example, a debt token on European logistics centers, equity tokens in U.S. workforce housing. This exercise isn't about investing now. It's about understanding the potential applications and keeping an eye on how this space evolves, so you're prepared if and when it matures. Thanks for joining me for this deep dive into the complex world of real estate tokenization. I'm Martin Maxwell. Stay curious about innovation, but always stay cautious and prioritize protecting your capital. Keep learning, stay strategic, and keep building one smart, well-researched move at a time.